Okay, so welcome everyone to buying investment properties in trusts versus personal names. We've actually had a lot of feedback from people wanting to know specifically about this topic. I've got a very special guest with me tonight, Martienne, and she's been speaking at our fast track events, and she literally gets mobbed by people afterwards wanting to ask so many questions around this. So we actually wanted to run a webinar based on this, and I'm really pleased that she's here with us tonight. So first, before we get started, I just got to do the company disclaimer. While every care has been taken to ensure the accuracy of the material presented, its employees, presenters, or any of its representatives will not bear any responsibility or liability for action taken by any person on the basis of the information contained in this seminar. The content is for information purposes only. It is recommended that no person make an investment decision until such time as their individual needs, desires and risk profile have been assessed by a qualified professional. What's really important here is that everyone's situation is going to be very different. This information is to really give you an understanding of some of the key concepts, and then you need to sit down with someone like Martienne or an accountant who understands structures and property to talk about your specific situation. Okay, so on tonight's webinar, we've got a couple of key important points that we'd like to cover. First one is the advantages and disadvantages of buying an investment property in trusts compared to your personal name. I can't tell you the number of people that we've had through our fast track events that have said, well, you know, I haven't bought anything in companies or trusts, and the people around me have said, don't bother, it's just a waste of money or it's a waste of time and effort. So once they really understand the significance, they're not happy. So this is why it's better to be prepared up front. We're also going to talk about the implications in a general sense about using trusts with regards to negative gearing, land tax, capital gains tax, and asset protection. Number three, the critical things you need to know to structure your assets for protection and maximum profit. Then we're actually going to delve a little bit deeper into the advanced uses of structures and also the future direction. And afterwards, we're actually going to have a session where Martienne will be available to anyone who wants to ask any questions. Now, for those of you who will stay to the end, I've got a very special bonus for you all, and that is the 10 hours of real estate investing fast track weekend that's been recorded, and it's worth $497, and we'll make sure that you get that. If you just stay at the end, I'll give you the link then. So it's a great bonus for those of you who will stay on to the end. Now, a little bit about my background. Some of you have met me through our fast track events, and some of you have seen me in all the videos that Conrad and I have already done. But for those of you who aren't familiar with me, I'm the Business Development Manager here at Investors Prime, so I work really closely with Conrad. Some of my background includes I'm a property investor, I'm a speaker, property finance educator, entrepreneur and author. I've done a lot of speaking all around Australia and New Zealand, including China and India and the US, to audiences as large as 4,500, and I've done that for the last 20 years or so. I've also been keynote speaker at iProperty and Smart Expos all throughout Southeast Asia. So I actually do a lot of speaking in other countries, and I teach them a lot about Australia, but what it gives me a great chance is to understand their property market, their legal frameworks, their tax structures, and their finance systems. So that gives me a great way to compare and contrast what we do here and to grab some unique or different ideas or different approaches from other countries and talk about them here in Australia as well. One of the other notable things that I've done is I've set up a Bank of Queensland branch, the North Sydney branch with my partners, where I was actually the owner and co-manager at one stage there. My background is that I have a passion, absolute passion for teaching others. I believe in paying it forward, and that's what took me down this path. My formal qualifications around teaching include a Diploma of Teaching and a Bachelor of Education, also a Diploma of Financial Markets through FinCEA. My career background is that of being an IT and business analyst and a project manager, so I'm very detail focused and procedural in the way that I look at problems and solutions. So when you come to the Fast Track event or listen to some of the other videos I've done with Conrad, you'll probably get a sense of that. Now tonight, I've got a very, very special guest that I'm delighted to actually have here with me. Her name's Martienne Angelique, and she is the owner and director of Savvi Accounting Solutions. So let me just tell you about what's so special about her. She's a visionary, an entrepreneur, she's a published author, wealth creation and structuring expert, and a keynote speaker. She's been a chartered accountant for 20 plus years, and she has a very, very broad range of technical accounting, taxation and advising skills. In fact, dare I say, probably more extensive and broader than any other accountant I've ever met. Her areas of expertise include wealth planning, business coaching and strategies, specialist taxation and self-managed super fund advice and strategies, structuring and asset protection. So she works with clients to plan, build and protect their wealth and success through consulting and mentoring services. This is coupled with her passion for property as well, which means she's an excellent base for advising on advanced wealth creation strategies. So my personal welcome to Martienne. Now, what I'd like to talk about is asset protection in the press. And some of you may have been hearing about what's happening with Gina Rinehart and her children. But the one that most people remember the most is Alan Bond. Obviously there was Alan Bond and there was Christopher Skase, etc. But these were people who, by use of structures, were able to get away with paying very little, in some cases, no money to creditors when they were sent bankrupt. So there are lessons in this of how to protect yourself. And I've always felt that you're better in that position of strength where you decide rather than having someone else's decisions thrust upon you. So Alan Bond's probably one example that most people remember, but if you read the Fin Review, and typically the types of people who do, who read the Fin Review and the Australian's Business Review are the sort of educated, smart money investors, and they're looking to do things smarter and better than the average person. So these are the sorts of conversations they're having right now about how to build wealth and what the right structures are and these sorts of things. So if you're not having these discussions and talking about these with the people around you, you're really missing out on a lot. And this is one of the key reasons why I've invited Martienne down here today, so we can go into these sorts of ideas and strategies and find out what other people are doing, but most importantly, find out why they're doing them. So this is one of the key quotes that I think is so important as a guiding principle that we all should be thinking about. So it's usually accredited to John D. Rockefeller, but some other people have said it was actually his great-grandson Nelson Rockefeller who actually said this. Whoever you decide has said it, it's a Rockefeller, but the secret to success is to own nothing but control everything. Some people shorten that to own nothing, control everything. Either way, the intention is there, to own nothing in your own personal name but control everything. People as far as Robert Kiyosaki and many others have actually used this same mantra throughout all of their teachings as well. So Robert Kiyosaki, obviously from Rich Dad, Poor Dad fame. So what I'd like to do now is really sort of hand over to Martienne and get her to speak about asset protection. So Martienne.
Thanks, Stephen. Hi, everyone. I hope you are having an amazing day so far and are willing to sit and listen for the next probably hour or so, just so that you can learn some really important things about structuring and asset protection. As Stephen was just saying, it's a really common thing to own nothing and control everything. One of the other sayings I love to use is we really want to be a pauper on paper. So as far as anything that we own in our own names, very, very little, but we just control everything. So asset protection, what is it and why do you need it? Asset protection really is about safeguarding your assets and placing them out of the hands of creditors in the event that you are sued or there's a judgment made against you. Asset protection is all about making it more difficult for the creditors to access your assets. Having your assets protected actually also reduces the risk of you being sued, because what can often happen is a solicitor may have a client come to them, they'll do a search to see what assets you may own, and if you have assets owned through different structures, it can be very difficult and costly for the solicitor to try and access those assets, so they may well advise their client not to go ahead and not sue. So asset protection can basically be broken down into three main areas. Most people are very, very familiar with the third one, which is insurance. Unfortunately, if anyone knows about the business of insurance, insurance companies are certainly not in the business of paying in the event that there's a claim. However, it's really important to have insurance on assets that you own in the instance that you can make a claim against them. The key thing where we like to structure is actually using structuring for asset protection. So there's a number of different structures that can be used in that instance, and we will go through those a little bit later. And the other form of asset protection is actually debt. So the ideal way to be structured would be to actually have a combination of all three of these types of asset protection mechanisms. Now, so the key is prevention's better than cure. It's very difficult to get insurance once you've had an accident, and it's very difficult to structure an asset once you're starting to be sued for it. So it's really important to get yourself organised and be very market ready even before you're looking at acquiring your assets.
Martienne, if I can just ask you, some people think that if a disaster happens, they can just quickly try to get insurance or structure things, or if someone tries to sue them, they'll just quickly set up the right structures. My understanding is that the courts can actually wind things back to a certain amount of time, and also insurance companies will not accept a claim if they know that it's in the process.
Oh, definitely insurance companies won't accept a claim. I think Jody, is it Rich or Rich, was it OneTel?
Yep, Jody Rich.
He tried to move all of his properties into his wife's name once he'd already started going down the drain, and yes, the courts overturned it all and just take those assets back and then apply to the creditors. So you can't move assets out of your own name in a time where there is potential litigation. You can only move assets in a time where there's no question of being litigated against and there are no problems within your structures at all. In that instance, then it's okay.
Right. Okay.
Yeah. Okay, so there's different asset classes, and each of the asset classes have different risk profiles. So broadly speaking, there are 4 types of asset classes. One, and again, most people will be familiar with these. The first one would be business, the second one would be property, the third one would be the stock market, and the fourth one generally is cash or fixed interest. So as I said, each of the asset classes have their own unique risk profile. Generally, the most risky would be business, because business can be sued from the customer perspective. There's issues with suppliers, also employees. Property would be the next most risky asset. You can have asset risk from tenants, and you can also have asset risk from people coming onto your property. And there's also landlord risk as well. The stock market would be the next down the line in relation to risk, and most of the time this would simply be market risk, the risk of the risk of the share prices moving up and down. And the last would be cash or fixed interest. So really the only risk there would be inflation. So each of those classes of assets have a different risk profile, but interestingly, even within each of the asset classes, there are subclasses, and they also have different risks associated with them.
So, Martienne, in terms of, let's just take the first one as an example. In terms of businesses, you could have a traditional bricks and mortar business, and you could even have online businesses. again, different risk profiles.
Correct.
You could even have, in terms of businesses, you could have a startup business model, or you could actually have a franchise model that you're taking on. Again, very different types of risks, because I know from a banker's perspective, you would lend very different amounts to each of those sorts of people.
Yeah.
But in terms of property, there's obviously resi property, residential, and there's commercial, and even within commercial there's industrial, there's office, there's retail, and then there's special categories such as retirement villages and caravan parks and all of these sorts of things. Even parking lots are a subdivision of those. So there seems to be like a very, very broad range of the types of asset classes within that, and even within the same asset class, let's say example residential property, you could be doing some as buy and hold, and you could be doing some as a renovation which you choose to on sell.
Yeah, we'll talk about that in a lot more detail when we get to the advanced strategies, but it just gives you an indication of all the different types of asset classes and subclasses that are around, and if you were to look at each one in their own right, there are certainly unique risks associated with it. And one of the keys with asset protection is making sure that you quarantine the risks. So things that have like risks would be grouped together. So you would never, as an example, have a business and in that business look at buying properties, because business being the most risky asset, if something was to happen and you got sued, whether it be from a customer or from an employee, that property suddenly could then be at risk of being used in the event of a litigation.
But, you know, Martienne, we've actually had clients that have come through the event, and they've even said that, that to save costs, their accountant has said, well, you've already got an entity set up for your business, just whack in your properties under that if you really want to put them under a structure. What would you say to that?
I'd say get a new accountant, but one of the most crucial things is a lot of the time accountants only look at things from a tax perspective.
Right.
They don't look at things from a long-term estate or succession planning point of view, or from a long-term wealth creation point of view. So if they're looking purely from a tax perspective, that may well be correct, but as an investor, you should never look at things from a tax perspective only.
Yeah, tax is just saving tax is the icing on the cake. It's not the reason why you do something.
Correct. You know, one of the things that's, we've always done is the key things when we are structuring clients that we look at is estate planning or succession, so it's for the long term, current asset protection, flexibility, and if there's a tax break that we can take, fabulous. But tax is the last consideration when you are structuring a client from a long-term wealth creation perspective.
Okay.
So what we're going to just show you next is quarantining assets and the importance of separating your personal assets from your investment assets and then also from your business assets. So one of the really, really crucial things is most people would own their home and their car and their jewellery and their savings in their own names. And when you look at investments, as we explained before, with the different risk profiles, we want to make sure that any investments that you do acquire don't ever have access to those assets in your own personal name that you've worked so hard to acquire. So by structuring, what it does is it actually puts a wall of security between you and your personal assets and then those investment assets and also business assets. So what we will do is ensure that you are structured from a business perspective to have your business in a separate structure, and then assets that you have for investment purposes are also structured separately, and neither of these would be in your personal name. And if there were ever any issues in relation to the investment assets or the business assets, they don't have any way of accessing the assets that you own in your own name.
So in summary on this slide, Martienne, so by having your personal assets in your own name, someone who attacks your business, or whether it's a supplier, whether it's a customer, or even a regulator. What you're doing is you're trying to quarantine, you're trying to separate your personal assets and your investment assets so that, you know, when someone comes after you, you can say, well, there's nothing in the cupboard.
Correct.
Well, you know, coming from a banking background, this is kind of the opposite of what, as a bank, we would taught to try to achieve for the bank.
Well, the banks don't like this type of structuring. The banks like to have access or cross-secure, cross-collateralise all assets.
Yeah, I mean, that's exactly what we were taught to do in the bank, and that was to make sure that we got all the assets from the client, and that way they couldn't leave because it was just too much paperwork, and we often had a loan that was cross-collateralised against multiple properties. But not only that, one of the sneaky clauses that I know the banks used to put in, and they still do.
They still do.
Yeah, it's the all monies clause.
Yes.
You know, and this is what really people don't understand, is this all monies clause. And you know, and for those of you who aren't 100% familiar with the all monies clause, you're actually giving the bank permission to dig into any one of your other accounts to provide funding for a shortfall in one of your other accounts. So if you fall behind, as an example, in paying your loan repayments, you've already pre-given them the approval to go into your savings account, or even a joint account that you may have, or maybe a savings account you set up for one of your children to dip in and grab that money. I've even seen a bank, by mistake, they've dipped into someone's self-managed super fund.
By mistake.
By mistake. And that caused a nightmare for the client, as you can imagine, because it's now non-compliant. So, you know, but from a banking perspective, their number one goal is to protect themselves.
Correct.
And that makes
our
sense.
number one goal is to protect you, not the bank.
Yes. So, I mean, all of this sort of takes a bit more paperwork, but, you know, in your experience, is it worthwhile for clients to spend a bit more time and set up the right structures moving forward?
It's more than worthwhile, it's crucial.
Do you have any examples of that you could share with us about people not being able to set this up the right way and then having to pay a cost?
I have had clients in the past, they've bought investment properties in their own name, and the onus recently from the court's perspective has moved away from insurance and, you know, if there's issues with the property. It's now the landlord's requirement to annually do a review of their property to make sure that it's compliant. And if it's found that there's an issue, and in this instance there were some issues with some back steps, the client knew that there was a problem with them and was going to get them fixed, but, you know, just didn't get around to it for whatever reason. The tenant had someone visiting them and they slipped down the back steps. And when it came to it, the insurance company wouldn't cover the claim because it's negligence, correct? Yeah. And it went to court, and the landlord was at fault, and he ended up losing his investment property and his home because he wasn't able to separate the two.
Yeah. Look, I mean, insurance companies will, in my experience, and speaking to literally thousands and thousands of people, will always try to find a way to either not pay or find a way to negotiate using leverage with you, saying, well, you didn't do this or that, to minimise their payout. So, you know, as much as we have insurance, they're very crafty. That's why they make so much money in terms of trying to get out of what they're trying to do. So you need to be as bulletproof as possible.
Correct. Yep, definitely. I mean, insurance companies are certainly not in the business of paying out claims. They're in the business of making a profit.
Yeah, collecting.
Correct.
Premiums. So let's talk about the specific structures, and then you can tell us a bit about the pros, cons, and how they work, etc.
Sure.
Okay.
Yep. So most people would be familiar with the different types of structures that there are available. The most common is in your personal name or as a sole trader. Then we have a partnership, and a partnership can be a partnership of individuals or a partnership of entities. We can have companies, and then we have trusts. And just a few examples of some of the trusts that are out there: a discretionary trust or a family trust, a unit trust or fixed trust, or a hybrid trust, or what's called a non-fixed trust. So they're some of the more common ones. There are many, many other types of structures that can be used, but for purposes of simplicity, these are what we'll be talking about today.
Yeah, well, Martienne, I actually grew up watching Charlie's Angels, and there was always a guy on the end of the phone, and they all worked for this foundation. And up until recently, I didn't actually understand what a foundation was, but it's just another legal entity.
Yes.
But it's not a very common one. But up there, you've also got partnership. Now, my understanding is that that's not a separate legal structure, but it's registered with the ATO. So do you want to just talk about what a partnership is and how people often use it?
Yeah, partnerships were traditionally used from a business perspective. Lawyers and accountants were always in partnership. And partnerships can also be, from a tax perspective, a husband and wife owning a property. As you said, Stephen, the taxing of a partnership is one thing, but one of the most crucial things that people get caught out on is the thing called joint and several liability. So when
I've heard that's bad, so tell us about this, because everyone looks at the blue sky, but they never think about the downside. And you know what? If you protect your downside, then you can relax and look at the upside. So tell us about this.
Well, as you would know, when you're a sole trader or doing things in your personal name, you're responsible for yourself. So if you're going out presenting yourself as yourself, then that's okay. People know who you are. With a partnership, it's a little bit different. So joint and several means that if you are holding yourself out as a partner, anything you do, you're liable for, but you're also jointly liable for anything that your partner goes out and does. So if your partner goes and does something that gets you into trouble or causes a problem with the business or the asset and you're unaware of it, too bad. The fact that you're in partnership with that person means that you're also liable for that.
So, Martienne, they could actually spend all the money in the partnership and rack up all this extra debt and literally have nothing, but then the whole debt falls back on you. Is that correct?
Yes, if they've held themselves out as being a partner while they did all of those things, then yes.
Yeah, so that's obviously something people need to be very careful of.
So partnerships are generally not used from an asset protection perspective because you're as liable for someone else as you are for yourself. So it can be a little bit dangerous. Unless you're doing a partnership of structures, then that can be different. But again, that's a little bit more of an advanced strategy. But just partnerships as a general rule, no, we prefer not to do partnerships. We prefer to have a legal entity to quarantine risks away from the individual.
Okay. Well, let's talk a bit more about the differences between these.
Yep. So the first one we'll talk about is the little man there with the briefcase. He is the sole trader or doing things in your own name. So you act as yourself. If you're running a business, you may have a business name, but it's still you, the person that's doing the things that get done. You're taxed as an individual, so you may be running a business, but from a tax perspective, you simply have a business schedule, and that business schedule is included in your normal tax return, and you're taxed at normal marginal tax rates. If you do anything wrong and you own assets in your own name, again, everything's just one big bucket, and any of those assets in the event of a sort of litigation or a judgment could potentially be at risk. The second one would be the partnership, which is the two figures holding hands or shaking hands. As I mentioned, the key issue is the joint and several liability. Also, there's personal liability. You are having assets in your own name as well as having a partnership of some sort. They're all lumped together. Generally, there's a partnership tax return. However, the partnership tax return flows, it's not taxed in its own right, it just simply flows through to the individuals, and the individuals are taxed at a marginal tax rate. Both the sole trader or own name and partnership of individuals is something that's really easy to set up. There's nothing that you really need to do. On the downside, it just exposes you, everything that you have is then exposed and up for grabs in the event of any litigation issues.
I understand that a lot of people choose this because of the low cost, but realistically, are they really thinking long-term enough? Because, you know, to go into business for yourself, you might need a business name, that's very inexpensive, and a partnership agreement that you set up with the ATO, that's, again, nothing. So, you know, this is why people are attracted to this, but is that really a good enough benefit?
No, no. When people are going to, say, start a new business up, what would be really beneficial is to go and talk to an advisor just to get an understanding of the risks associated with the type of business you're setting up. So if you're a tradesman, a plumber or an electrician, you could imagine that there's a much higher risk associated with that business than you setting up some sort of online affiliate business.
Right.
So it's just important to understand the risks associated, and then you can make an informed decision. Another option for small businesses is to maybe see how they go for a little while and then transfer the business into a structure.
Right.
So
a structure like the XYZ Pty Ltd?
Well, I prefer that people don't run businesses through companies or own assets in a company directly. Yes, it's a separate legal entity. It has limited liability and it's taxed at a lower tax rate than the highest marginal tax rate for individuals. However, it misses one of the key things. They changed that, and I was trying to work out when. I don't want to show my age, but I think it was in the 90s, 97 maybe. They removed the benefit of capital gains tax exemptions from companies. Prior to that, everybody got a capital gains tax exemption. They used to do marginal, they used to have different ways of calculating it and everyone had access to it, and then they changed it and companies lost that benefit. So companies also are restricted in taking money out of them, so the ATO has put a lot of rules and regulations. Division 7A is one of the key ones. You can't take money out of a company generally unless it's from a taxed source, which means it gets paid out as wages where tax is already paid, or it can get paid out as dividends, again, tax is already paid. So a company is definitely a separate legal entity and a better scenario than in your own name, but it also has, with that, a number of restrictions around that as well.
But there's ways to leverage off the benefits or the power of a company.
Yes, yes. What we do is we utilise the company to be part of the trust structure.
Okay.
So we'll talk about trusts next. Now, I notice you've got a little note there about land tax and stamp duty. We'll touch on that in the next couple of slides because it'll be a little bit more in context than it would be right now.
Sure. Okay. Well, let's go to the next slide. Trusts. Now, if I can just share with you what my knowledge of trusts were when I first started down this path, was that in medieval times, Knights of the Round Table, before they went on their conquests and sieges, what they would do was they would find another male, because women couldn't own assets back then, they would ask them to hold those assets they had in trust on behalf of the beneficiaries, which is usually the wife and the children. So that was my understanding of where trusts arose from. Do you want to expand on this a bit more and tell us?
Yes, so trusts have been around basically since the Norman Conquest. As Stephen mentioned, the reason that they were initially even created is the knights and the lords and the earls would go off to war fighting with the king, and in the event that they were to get killed, their assets just reverted straight back to the crown. So any wife or children that may have been living on their properties were turfed off and the king got the assets back. What happened then was the ability for the knights to actually appoint somebody else to manage the assets on their behalf for the wife and children in the event of their death. So what happened is the Magna Carta, basically trusts were mentioned in the Magna Carta, but in that document, as Stephen mentioned, women were not allowed to own property. So it had to be somebody else that was able to control the assets on behalf of the wives and children. So the key players, so there's one role called a settlor, and a settlor actually creates the trust. So if we use the example back to medieval times, it would have been the knight going off to war, basically asking the trustee, could he take these assets and look after them on behalf of the beneficiary. So he was settling the assets on trust for his wife and children to be looked after by the other person, which their role was the trustee. So the very principle of trusts, especially discretionary and family trusts, hasn't changed for many, many, many years.
So it's a long history.
Very long history.
Behind this.
That's right.
So rock solid.
Yeah,
okay.
and there's been lots and lots of talk through media and you know, the ATO saying they don't like trusts. But the key thing to remember is trusts are used for structuring asset protection and long-term succession planning. You don't set a trust up purely for a tax benefit. You set it up for the long-term succession asset protection structuring perspective. If that's your reasoning, the ATO can never overturn that because your reasoning isn't to avoid tax.
Well, and sure, my understanding is some of the biggest users of trusts are politicians,
Yes.
lawyers,
Yes.
judges, and also farmers as well. So there's so many key people using these that I don't think they'd want, nobody would want these taken apart.
No, the politicians would never pass legislation that would harm them in any way, so I think we're pretty safe.
Sure, good, okay.
So we'll just talk about some of the key roles in a trust. The trustee and an appointor. So if you were to imagine the trust asset, use a pen as an example here, Stephen. I settle this pen upon you and I now create a trust.
Right.
So you can be the trustee. So your role is to actually manage that pen on behalf of whoever the beneficiaries are. And that beneficiary can also be yourself.
Right.
One of the key roles that is in the trust is actually the appointor. That is the most crucial role in the trust. The appointor, the principal, a number of different trusts have called them different names, but the ultimate role is exactly the same. This role has the ability to remove and appoint a new trustee.
Right.
So it's the key role.
Mm.
So the number of, as I mentioned in the last slide, there are a couple of different types of trusts, and we'll just talk about the main common ones at the moment. So the discretionary or family trust. So there's no fixed entitlement. So no individual person owns the asset in a discretionary trust. They don't have a fixed entitlement. It's up to the trustee each year to determine which beneficiary receives the income and or the capital of the trust.
So in some years, you're saying the trustee may give no money to some of the beneficiaries, and in some years give equal amounts.
Yes.
And they can vary.
Correct.
Right, okay.
Correct, yeah. So there is no fixed entitlement, so the trustee determines. So in most families, the appointor, or I prefer dual appointors, and we can touch on that a little later.
Sure.
But the appointor and the trustee would normally be the same person, and if the trustee is a company, that would be the director. So ultimately it's the same person that is determining who the distributions go to each year. But they can be different people in large families, or where you've got scenarios that, you know, wealth is passed from generation to generation. Those roles may not be the same.
Okay.
So the next, and when a beneficiary receives a distribution, it's taxed at their normal marginal tax rates.
Because the trust is just a flow-through vehicle, isn't it?
In essence, the trust can elect not to pay distributions out to the beneficiaries. However, there's quite a high penalty tax, so most of the time it's to the benefit of the trustee to make the distributions out of the trust. So the next type of trust would be a unit trust, and with a unit trust there's what's called fixed entitlements. So the unit holders own a specific percentage or share or number of units in the trust, and the unit holders, again, income flows down to the unit holders based on the predetermined entitlement, and ultimately flows down to an individual who pays tax at marginal tax rates.
So Martine, in this case, the trustee can't pick and choose who gets what,
No.
or who gets nothing.
No.
They have no say in that.
No, that's right. So the trustee must make distributions in accordance with the fixed entitlements.
And I actually understand that this is more risky for some people if they get sued because of that fixed entitlement, whereas a discretionary trust.
Correct.
Do you want to just expand on that?
It depends on how the unit holdings in a unit trust are set up, whether they're set up to be owned by a discretionary trust or whether they're set up to be owned by an individual.
Right.
If it's owned by an individual, that defeats the purpose of structuring or asset protection, because if something was to happen to the individual and they get sued, one of those assets are the units that they hold in their trust.
Right.
So,
whereas that's not the case with just a beneficiary of a discretionary trust.
No, because a beneficiary doesn't have any fixed entitlement, so they don't have an ability to be sued for the assets owned in the trust.
It's good to know. Okay.
Yeah. And the last one that we'll talk about is a hybrid trust, which is actually a combination of a unit and a discretionary trust. The trustee has discretion to distribute income, but unit holders always have a fixed entitlement. So there can be discretionary hybrid trusts or unit hybrid trusts. Again, they can be used in a number of different scenarios, and we'll touch on hybrid trusts a little bit later in the webinar.
So how about a bit of an example, a diagram to explain this a bit more?
Yep. Okay. So as you can see in the diagram, there's a trustee and then there's a trust. Under trust law, the trustee together with the trust form the legal entity. The trust on its own right doesn't form a legal entity without the trustee to manage it. So the two together form the legal entity. Now, in this example, we've got a corporate trustee as the trustee of the trust. Now, the reason that we do that is, if you recall back to our picture earlier when we had a wall of protection between an individual's assets and investment assets, the reason that we put a corporate trustee in place is under trust law, if the trust is sued or has a judgment against it and there is a shortfall of assets in the trust, the judge can look to the trustee to satisfy any shortfall. Now, if that trustee was you, the individual, suddenly your personal assets could be required to satisfy a shortfall. However, what we do is put in place an empty company which just simply has paid up capital of $100 or something. It owns no assets. It doesn't trade. Its old-fashioned name would have been a shelf company.
Right. Do you want to just explain why it's important it's a non-trading entity?
Because a non-trading entity is required so that there are no assets and liabilities in that entity, because it's the same as if it was you, the individual. If that was a trading entity that was the trustee and there was litigation that resulted in a shortfall, they look to the trustee to satisfy the shortfall. So the trading entity could then suddenly be taking all its assets to satisfy any shortfall in the trust.
Right, okay.
So what we want to do is have a separate entity in its own right. It has no assets or no liabilities and it does not trade. Its role simply is to act as the manager to manage the assets of the trust on behalf of the beneficiaries.
Great, okay.
Yeah. Now, the other key role, so you as the individual would be the director and shareholder generally of the trustee company. In more advanced scenarios, the shareholding could be in another entity, but a director generally needs to be the controlling individual there. And the other role that's really crucial, as I mentioned before, is the appointor. And then the beneficiary is just listing out generally the mum and dad or the husband and wife initially.
Now, I actually noticed on the site, and this is something that the first time I saw you talk about this, a light bulb came on for me, because in the past I've spoken to many different accountants and they've all said, you know, have an appointor, but you were the first one who's actually told me you should have not just one but two appointors. Now, if you can just explain to people why that is, and also talk a little about your background, because you've specialised in helping a lot of business owners and people who are facing bankruptcy. And if you could talk about the appointor 1 and 2, particularly from that frame of reference of being sued and going bankrupt.
Yep. Quite a few years ago, the bankruptcy laws changed that basically gave the bankruptcy trustee a very broad ability to access assets. So if there's one appointor in a trust, you've gone to all the trouble of structuring and you have all of your assets and there's something that's happened and suddenly you're in a dire situation and that you know are facing bankruptcy. Under the bankruptcy legislation, the bankruptcy trustee can take control of your trust via the appointor role. Most trustees, what they do is if an individual becomes bankrupt and that individual is in the role of a trustee or an appointor, they get removed because they're under a legal disability. So the trustee, the bankruptcy trustee, can then step in and suddenly control all of the assets. However, if there is dual appointors and the other appointor is not bankrupt, the bankruptcy trustee has no control over the second appointor. So because there's a 50-50 split between appointors, the bankruptcy trustee can't control the second appointor, so they can't demand that the assets within the trust are sent to the bankrupt estate. So you basically retain control of your trust. And I've had personal, experience with that and clients and all of that. What happens is the trustees will write to the appointors and demand information, and the appointor has no obligation, the second appointor has no obligation to comply with the bankruptcy trustee because they're not bankrupt. So what it does, it really safeguards your assets by having a second appointor in place.
See, I actually find this extraordinary. People go to the trouble of setting up all these companies and trust structures to ultimately protect themselves, yet they don't realise they have an Achilles heel. So even people who actually have structures and spent a lot of time and money setting these up, if something goes wrong, it's too late, you can't fix it. This is why it's so important to know the right people with the right information. I think that one little gem is worth the whole webinar, especially for people who actually got structures already.
Yes, yeah, definitely agreed. Okay, so just the next slide will show you an example of a number of structures, and where's the houses?
Okay.
So you have a number of investment properties, and each property is within its own structure. But as you can see, you're the director of the trustee companies, and there was 3 different companies with 3 different trusts and 3 different properties. So you as the individual would control the company as director, and you would also be the appointors, and you would also be the primary beneficiaries. And it just goes to show you visually how you can control the assets even though they are in separate legal entities. So you own none of those, but you control all of those.
Now, this might be a bit of an advanced question, but some people may say, oh, I don't want to spend the money of setting up a company and trust for each of my properties. What would you say to them?
There's a few things that I would say are probably not appropriate on a webinar, but people need to have a long-term focus. So if they're buying a property worth $300,000, $400,000, $600,000 and they're worrying about a cost of a couple of $1,000s to structure and protect that asset, I'd be wondering where their concern is.
Well, I mean, particularly if that asset over the next, let's say 10, 20, 30, 40 years, not just doubles, but quadruples or goes up 8 times.
Correct. It's negligible.
You could have several $1 million of equity per property, and if you amortise the cost of the setup over 20 years...
It's negligible.
Yeah, that's right.
Yeah. So it's really important with all things, if you're looking at acquiring a wealth portfolio that's going to generate you a passive income stream at some future point in time, then you've really got to have a long-term focus and understand that you need to structure things properly now because it's much, much more difficult to fix them at some later point, and it's generally quite costly as well. Now, we were going to talk about land tax as well. Land tax is a really big concern for a lot of people. Unfortunately, it's one of those costs if anyone tries to be successful and get ahead, the government want a cut of that. However, there are ways that you can minimise it, and it's just a matter of simply understanding how the different states group. So Victoria groups by trustee and doesn't really delve much further down than that. Queensland groups by beneficiary, and New South Wales groups by trustee, but I believe they delve down to the directors or the controllers, I think the terminology is. So it's just a matter of understanding each state, and that just sort of supports the validity in having a separate quarantine structure for each property. Now, there's a little bit more stamp duty payable again. There's the assumption that if you have structures you must be supremely wealthy. The objective is you are going to be at some point in the future, but they'll normally charge a little bit more for stamp duty. The bottom line is there are just some costs that need to be incurred to ensure that the long-term wealth and protection of your assets is set up from day one, and they're just some costs you have to factor in initially and then they're dealt with.
Okay, great. Yeah. Now, this example has actually your principal place of residence and 3 of your properties in here. The reason we put it in here is because obviously you're doing this to get a maximised result. So you want to protect your assets, you want to quarantine them, but what if there was also a way that you could actually combine the power of that with paying off your property really fast? So I know you're aware of how this is done, but this is the thing that Conrad teaches at the Fast Track event. So some of you may want to get a further understanding of how to leverage and pay off your property and how to structure your loans and your offset accounts and everything to in some cases save decades or even hundreds of thousands of dollars off your mortgage. And this is something that is taught in great detail at our Fast Track event. Or you can actually just contact us and Conrad can have a consultation with you over the phone, put you in touch with the right members of the team. So we won't go into too much detail about that, but ultimately there's a way to leverage off all these structures and your properties to have an even greater benefit in your principal place of residence home loan as well.
Yeah.
Okay, so I want to talk about some advanced topics, and if we can start with, many people have actually got assets that they already own in their current names, and the biggest question we often get is, oh, I understand the power and the value of having structures. Should I transfer all of my personal owned properties into those structures? That's probably the number one question we get. And everyone's situation is different and what they require is different, but if you can just give us a little bit of an idea about your thoughts on that topic.
Sure. Again, as Steven said, that this is a really common problem. Most people will buy their first or second investment property in their own name without getting advice from anybody, and then when they realise that there is a different way to do it, they panic. Early on in the presentation I mentioned that there are a couple of different ways to utilise asset protection. Structuring is the easiest way to protect assets, but there are also a number of other different ways. So where assets are in your own name, some of the strategies that we could look at is using debt to make sure that there is no real available equity there for any potential litigant to access. On the slide you'll see structured debt strategies. We work with solicitors that create a number of layers around structured debt to basically take any equity that's in the properties you own in your own name to be out of your name. Another option can be contractual wills, and again that's a very advanced strategy, but in essence what you do is you contract any equity you own to your future estate so that in the event that you get litigated against, there's already a contract in place. So there are a number of different things that can be done. They're not as watertight as utilising all three. However, generally there's not the cost benefit of transferring those assets into its own structure because there's all the stamp duty, capital gains tax issues, etc., etc. So normally you spend the money on other strategies in that instance.
Yeah, and we've also got mentioned up there overseas structures, and I know that you're very familiar with overseas structures as well.
Yeah.
But it's really just having the right combination of what works for the person's particular situation and particular outcomes, correct?
Correct. And also, whatever their longer term objectives, what are they trying to achieve? And mentioned on the slide as well is wills. One of the key things when you have structures is to actually make sure that you have a will, and in your will what you do is you determine the roles within each of your structures and how those roles are dealt with under your will. So assets that are owned in structures don't go through probate, don't have the government accessing them and holding them up for a year or two and trying to work out what happens. Because they're owned in their own legal structure, upon your death, they just continue because those legal entities continue. The key things that your will would deal with would be appoint all roles, director roles and the like, so that you can still have those assets controlled and you determine who takes control of those assets under your will.
Yeah, so the bottom line is that when you actually have more complex structures, you need to just document that in a will so that, you know, we're all going to die one day, right?
Yeah.
So,
Damn.
so someone knows what to do and it doesn't have to go through court and be a whole problem for the person trying to administer it.
Correct. Yeah.
Okay.
Yep.
All right. This structured debt strategies, you know, I like to say it's a bit like playing the bank's game for yourself. So from a banking perspective, you know, we often used to have people coming for first mortgages, but occasionally we get people for second mortgages and the like. And I think understanding the power and the use of second mortgages, whether they're registered or unregistered, these are things that, you know, in my experience, they don't cost very much and they don't, very importantly, trigger capital gains tax events or stamp duty events. So they're actually really, really cost-effective, powerful tools if you know how to use them and structure them the right way.
And if your advisor knows how to set them up properly. That's the crucial thing.
Most people I've spoken to in the past never knew how to use these. And even when I was in the bank, when I would explain this to sort of my colleagues in head office, they still wouldn't. They'd just roll their eyes. It's like, no, that's not the way we want it done. I go, well, this is what clients have and this is the reason why. And they just didn't understand.
Yeah. No, and it's a shame. It's basically taking the secrets of the rich and wealthy and sharing it with those that are wanting to achieve long-term, you know, financial freedom. So now we were talking earlier about, you talked about structures in relation to having assets where you're having a long-term hold, and I said I'd talk about that later. With quarantining assets, Stephen was talking about, in the event people might have properties that they're going to buy and hold for the long term and wait for those assets to grow. And a lot of people really like to do flips and renovations. So what you need to make sure is that you don't have those two types of investments in the same structures. You would have them completely separated, because the renovation and flip strategy is in essence a business strategy, and you're not waiting 12 months before selling and having a 50% capital gains tax exemption. In that instance, you're basically running a business of renovating and selling properties, so any income you have is ordinary income, and that's separate to the long-term investment properties, which, if they are sold, are able to have access to the 50% capital gains tax exemption.
So what you're saying is, if you don't structure this the right way, all the properties that you sold that were long-term buy and hold that you only expect to pay capital gains tax on, you're going to be paying income tax on.
There could be a confusion as to what is the intention of that structure. So, and it can also happen when people use multiple trusts under one trustee. The tax office can question, what hat is that trustee wearing? Is that trustee hat an investment trust, or is that trustee hat a business trust? So it's really important to completely quarantine those and not lump everything into one basket and potentially be taxed on 100% of your gains.
So literally, by getting this wrong, and if you've held long-term buy and hold property for a decade or two, and that property's doubled or tripled or whatever else, you could be paying literally hundreds of thousands of dollars extra to the tax man because you didn't structure this the right way. Wow. Okay. Now, tell me about, I've heard that in some cases you may need to resettle a trust. It doesn't happen very often, but I've heard some people talk about this, and the implications of which, my understanding is that you might be up for stamp duty and create a capital gains tax event. Yes. So tell us a bit about resettlements of trusts and how you can avoid this sort of nightmare sounding scenario.
The idea is you don't want to ever resettle a trust. When you resettle a trust, any assets that are in the trust are deemed to be disposed of, and that triggers capital gains tax, stamp duty on the reacquisition, etc., etc. It often happens when people get divorced. They'll come in and they'll say, I want his name off the document, or I want her name off the document. At the end of the day, when a trust is initially set up and we list primary beneficiaries, the deed has the ability that it can make a distribution to pretty much anyone in the world that's a natural person, along with the approval of the appointer and the trustee. So in the event that there's a divorce and one of the spouses is no longer part of that asset any longer, it makes no difference because the trustee elects who the distribution goes to, and in the event it's to the spouse that's no longer on the scene, that person will never receive a distribution. So there's no need to remove them off the deed. So some of the other things it's really important to cover off when we're talking about deeds is, unlike companies, the Australian Securities and Investment Commission have a massive body of law that covers companies and their compliance. With trusts, it's very different because the trust deed or the deed of trust is the law of that trust. So it's really important to make sure that the deeds that are created for you are flexible enough to ensure that they cover off exactly what you need and are not worth less than the paper that they're written on. I've had over the years, clients come to me with deeds and they've had them set up by someone that didn't know what they were doing, or they thought they'd just go and set them up themselves online and have got themselves into a pickle. They don't understand the different roles. They don't understand how the banks deal with trusts. They don't understand the long-term succession planning implications of different things. So it's just really important to make sure that when you're setting up new structures that you utilise an advisor that knows exactly what they're doing and that they understand what you're trying to achieve in the long term. So it's again another factor of thinking that you're going to save money that in the long term could well bring you undone.
Well, Martienne, while we're talking about trust deeds, I know from my banking background that when someone actually had a trust deed that listed children in there, that we'd have to get guarantors, guarantees from the children, but sometimes they were actually too young. Yes. So did you want to talk about the details of the trust deed and listing of children?
Yes, well, I actually had a really interesting structure that came to me one day for a client that was looking at buying a property. She'd set up a trust. She wasn't even listed as the primary beneficiary on the trust, and her two children who were under 10 were listed on the trust. Now, the problem that happened is, as a general rule, the bank wants the directors and the primary beneficiaries to guarantee the loan. Now, in this instance, my client wasn't even listed as a primary beneficiary. Her two children were. So it basically couldn't happen. The trust was useless and was unable to be used at all. We had to then set up a new trust. We then had to go back, get the contract renegotiated into the new trust's name. It was a real nightmare. Mm-hmm. And she thought she was, doing the right thing by setting it up, prior to that without right advice. So the key thing is the banks like guarantees. And the other thing that can be when your children get to sort of 18, you may have had a trust around for a while and you've got two kids that may be at university and you're doing another property acquisition in your trust, the banks suddenly want to tie up your 18-year-old, 19-year-old children that are at university and get them to guarantee loans, which can cause all sorts of problems for them in their own right for when they're ready to buy an investment property.
Yeah, because banks will generally hit their credit file.
Correct. Mm-hmm. And they've also guaranteed a loan.
That's right, which reduces their borrowing capacity.
Mm-hmm. Yep. So, so there can be all sorts of trouble. So never ever put your children onto your trust.
You mean list them individually? on the trust?
Yeah, never put them in, no.
Okay, all right. Well, let's talk about the future. And this is another common question that we get from clients is about, well, what if the government changes the laws? Now, personally, I don't think that there's much appetite to change the laws around this because all the politicians and the judiciary and the lawyers, they're so vested in this themselves because they get tremendous benefit. But what if there are some changes? Do you want to just talk about that?
It depends on the perspective you're looking at. If you're looking at trusts themselves, there's hundreds and hundreds of years of common law around trusts. So it's unlikely that trusts, the way they're currently set up and used, will change unless there's some significant event that I could not even possibly foresee. Tax, on the other hand, changes all the time. So the key thing to take away is making sure that you do structure from a long-term wealth creation and succession planning perspective, not from a tax perspective, and to make sure that things change. Everything changes, and it's just a matter of being flexible and making sure you're aware of the changes and your advisors are as well.
Yeah, one of the terms that you often hear about is that grandfathering. So if people have acquired an asset or they've done something based on the legislation, then even if they do change it later on, they don't often go back and make it subject to that. Is that right?
No, generally the grandfathering mainly in the last few years has been around self-managed super.
Right.
So self-managed super funds, because they kept changing the legislation in relation to how assets could be acquired within the funds, they had grandfathering provisions that allowed a long period of time to ensure compliance with the changes in the legislation. So grandfathering would normally give a significant amount of time for people to then look at alternative strategies to ensure that they're not, penalised in any way.
Okay.
Yeah.
All right. Another common thing that people ask us about is, well, what happens when the trust ends? And that's to do with the vesting date. So, and some people have talked about, well, it's 80 years or less, but what about in South Australia where there's no vesting dates? You want to just talk about what a vesting date is and what its implications are in South Australia?
Yeah, a vesting date is the ending date of the trust. Most trusts nowadays have a vesting date of 80 years. They've had many that, can be from 10 years, 5 years, and as Steven said, in South Australia, they removed the vesting legislation. So in South Australia, you must be a South Australian resident, but trusts in South Australia have no vesting date. So a vesting date simply means that the trust ceases and all assets held by the trust would be distributed down to the beneficiaries. As it stands, this is a topic that's been talked about for a very long time, as far as I can remember. And what I believe is that there's going to be at some future point some legislation change. Again, look to the politicians who have structures. So when it comes around to the times their structures will be vesting, I'm imagining that the vesting legislation within each state will change, or there'll be amendments that will allow the longevity of the trust to continue.
Okay, all right.
So again, it's an unknown, but it's just something to be aware of in the future. They say 80 years is sort of 4 to 5 generations. So
yeah, it's still not enough. Still not a good enough reason to move to South Australia, in my opinion. Sorry for the South Australians listening.
No, not unless you love churches.
I want to ask you this: how do you identify the right person to give you advice? How do you know that your accountant is a property specialist who actually understands all of these sorts of concepts? I mean, in my opinion, in my experience, I should say, when I first started going down this path, I literally spent over $10,000 of my own money, literally going and elevating myself from one accountant to one financial planner to one lawyer to the next, trying to learn from them and then find the people who really knew stuff. Because what I found was so many actually had no idea about this type of long-term planning and asset protection. So how does someone find the right person? What sort of questions do they ask, particularly around property and asset protection and longevity?
Yeah, okay. Well, accountants generally aren't taught this sort of stuff. Lawyers are the ones that normally are dealing with sort of succession planning and you know, estate plans and that type of thing and structures. Accountants aren't taught this, so most accountants that would have knowledge in this area would have gone and sourced the knowledge themselves.
Right.
Most likely they would be property investors themselves. So one of the key questions I've told clients to ask their accountants is the first one, ask their opinion about property and property as an investment. Next, ask their opinion about structuring and see what sort of question and answer comes to that. Then the next question that I would ask is, how many of your clients have you structured in the past? And again, that's going to be a really telling question. A lot of accountants will say it's a waste of time or a waste of money structuring. Run.
Yeah, I absolutely agree with that.
Yeah, run. They may say property's too risky or too dangerous. Run. What they're doing is they're giving you their personal opinion of something that they don't know about, and rather than just saying to you, look, no, I'm sorry, I'm not sure, or no, that's not my area of expertise, what happens a lot is they'll say that it's dangerous or risky or no point doing it. So when you get those sort of answers, they're not going to be the best advisors for you in relation to your long-term wealth creation. So ask them their opinion about property, ask them their opinion about structures, ask them their opinion and how many structures they've set up, and that should give you a good indication of you know, their level of knowledge around that area.
Okay, look, that's great, Martienne. We were actually starting to get towards the end of the presentation, and I'm going to just talk about a few things, and then we're going to open up for questions, if that's all right.
Yeah.
So for those of you, as I said at the beginning, if you stay around to the end, you'll get access to this 10-hour home study of the real estate fast track that was recorded about 1.5 years ago. So the information is about 95% current, but at least you can watch this again and again at your own speed in the comfort of your own home. So at the bottom of the screen, you'll see that it's www.realestate-dvd.com.au/absolutely-free-access-2016. So if you type that URL in, you'll actually be able to get access to Conrad's Real Estate Investment Fast Track. As I said, it's about 1.5 years old, but it's still very accurate. Now, if you'd like the most accurate version of it, I'd like to invite you to our next Real Estate Investing Fast Track event. It's actually on the 10th and 11th of September, and you'll hear not just Conrad, but other members of his team speak, including myself and Cameron Fisher and Steve McClatchy, and of course Martienne will be there as well, so you can actually get a few more pearls of wisdom from her and take her aside and just ask her a couple of very specific questions about your situation as well. We have actually very limited seating for this, so at the moment there's 12 seats left, so I'd love to invite you to this one, and if you can't make this one, we'll have one in the future. If you just go to realestatefasttrack.com.au, you'll be able to register for this workshop. Now, just to give you a bit of an overview of this workshop, the first day is just in the classroom, where we literally lay the foundations, the framework of all this information, and day 2 we actually go out into the field and we put a lot of this into practice, then we come back and then consolidate and summarise all of this. We look after everyone in terms of you get fed on both days, and normally you would pay for this, but if you go to realestatefasttrack.com.au, you'll be able to pick up one of the tickets online for no charge. Now, this event is valued at over $300 because you'll actually get a home study, you'll get a whole lot of other bonuses, including Conrad's book, which he sells about 400 a month all around Australia via Amazon and Dimmix, etc. So it's a really, really good event. And at this event, there is absolutely nothing you can buy, nothing you can sign. So it's a purely education event. It's really to showcase our team and what we do, and how we specialise in helping people build really smart property portfolios using some advanced structures and amazing finance strategies. Now, we've probably covered a fair bit of ground tonight with Martienne, and many of you would love to listen to this again. You'll all actually get a link via an email sent to you tomorrow with a webinar replay, and you'll be able to watch it again. Make sure you really understand the topics, and you'll also get the link to that free home study, so you can watch that at your leisure as well. So now what I'd like to do is open it up to questions with Martienne. So what I'll do is I'll actually just kick off, because I actually want to know more about hybrid trusts. I've heard a lot of people talk about hybrid trusts, and there's a couple of groups out there that talk about them in particular, and some of them have said it's the smartest and best way to go, but I've also heard that the ATO was targeting them as well. So I'd like your opinion on these sorts of structures, please.
Sure. Hybrid trusts have been things that have been talked about for a couple of years now. Basically, we touched on hybrid trusts a little bit earlier. So a hybrid trust would own a property, and the units in the hybrid trust you would own, and you would go to the bank and you would get a loan for the units in the hybrid trust. Now, what this would allow you to do is you would personally in your own name be able to claim the interest on the borrowings, because people are very concerned with negative gearing. However, what the idea would be is you claim the interest in your own name while the property is negatively geared, but when the property is no longer negatively geared and turns positive and or is ready for sale, you transfer those units to another individual or entity. And this is what the ATO had a massive issue with. They say that you cannot claim the benefit of the tax deduction without at some future point bringing the profit to bear. So you can continue to use a hybrid trust in that way, but ultimately in the longer term you're going to have 100% of the income and 100% of the gain in your own name. My concern with these structures is that the units of the hybrid trust are actually owned in your individual name. So what happens is, yes, there's a debt against you personally, but those units are attached to an unencumbered property that is owned in the hybrid trust, because the loan isn't in the trust, the loan's in your name for the units. So they were a creative way that someone initially came up with to try and get the benefit of negatively gearing and then assigning the income and the capital at a future point. But the ATO have a number of rulings around that if you take the tax deduction, you must receive the income at a future point.
Right, so they're probably not as good as what I originally heard they were.
No, they're not good on two fronts, as I mentioned. One, the fact that the units in the trust are owned in your personal name, and those assets in the hybrid trust are completely unencumbered, so you don't even have the benefit of that. And at some future point you're going to have a very big whack of income in your own personal name, which is the marginal tax rate, 48.5%. Ouch.
Oh, right. That's not ideal, is it?
No, definitely not ideal. So again, you know, one of the keys is you do not structure or buy investment properties purely for a tax benefit. The acquisition of something for hundreds of thousands of dollars is a transaction that must have a long-term focus.
Right. Okay.
Not a short-term tax focus.
All right.
Yeah.
Martienne, I'm actually this is a bit of a tangent, but I'm actually a big Paul Kelly fan. And Paul Kelly's got this great song that I think is a great guide to investors, and it's about from little things, big things come. And I didn't actually realise the significance of it until one word popped up in his song. And the story's about Vincent Lingari and the cattle station that they were on, and they all walked out, about 200 of them, quite a long time ago, and then it ended in 1975 with Gough Whitlam, pouring sand through Vincent's hands and handing the land back. But it was who the land was leased to which really caught my attention in that story, and it was the Vesti Pastoral Company. And the Vesti Pastoral Company, the people who make spam, and I grew up eating spam. And so the reason it rang a bell was I've heard about these Vesti trusts, and can you just expand about what they are, and a little bit about the background about the Vestis and why it's so significant?
Yes, the Vesti Trust is a name given just to a type of trust that really is a normal trust. It's just a name that's given. It's just the way that they're utilised and some of the strategies that are used that are quite clever from an asset protection perspective. But the Vesti brothers were quite wealthy and successful. They had quite a big business quite a long time ago in the UK, and they were quite clever, and they were siphoning profits offshore so that they were taxed in more low tax jurisdictions. So they were quite clever. Someone worked out what was going on, so they brought in some legislation to make sure that they couldn't do that, quarantining things where they came from. And what the Vesti brothers did in the end was that any of the assets that they owned, they basically gifted into trusts, and those trusts then continued to run the businesses, and the income and profits were flowed wherever they were initially being flowed. The UK government spent sort of 50 or 60 years, I believe, trying to access the assets within their structures and was not able to do so. So it's just another really good example, like the Alan Bond and those other people, how structures can really make sure that your assets are rock solid. And even 50 or 60 years of the UK government trying to access all these assets that the Vesti brothers held, they weren't able to. So yeah.
Right, because one of the things that you kind of mentioned a bit before, and I understand this is what the Vestis did, was they had structures within structures. So it wasn't just a flat company and trustee.
No.
That they were doing other things
Yes.
as well. Do you want to just expand on that a little bit? How you can actually have, how you can use complex arrangements where you might want to gift some of your equity into another entity. Do you want to just mention that a little bit?
So gifting is something that's been around for a really long time, and that's one of the things that the Vesti brothers did do, is they gifted their assets into a number of different structures, and it wasn't just one structure and it wasn't just one jurisdiction. So they had businesses across a number of jurisdictions. They gifted those assets into the trust, so therefore they didn't own them anymore. And what the government were trying to do was access that gifting back and to reverse that, so that they could then say that the assets were back in the brothers' names, and then they would have access to them. But the gifting laws are very strict and strong. And there's a number of things that can be done. You can gift and then you can loan the money back from the trust, thereby creating a mortgage, and that can be caveatable, and there's lots and lots of different advanced things that can be done. But that was just an example of a significant one hundreds of years ago that stood the test of time.
Right. Okay. So Martienne, we've talked a lot, and we're getting a lot of questions relating to the costs and how difficult it is to set up companies and companies as trustees of trusts and these sorts of things. And so can you just talk a little bit about the costs? What are the initial costs and the ongoing costs for companies and trusts?
Yep. Normally a company trust structure to set up is about $2,500. That includes the company and the trust. And on an ongoing basis, the company doesn't need to lodge a tax return. That's simply something that sits there as a dormant entity. It has an ASIC annual fee to make sure that it maintains its registration status, but it doesn't need to lodge a tax return. The trust will have income and expenses and need to lodge a tax return, but there's no annual compliance other than the lodgement of a tax return.
Okay, so how long does it take to set these things up? I mean, and who do they go to? Do they go to an accountant, or do they go to a solicitor, or who's the right person to go to, and what's involved in setting these things up?
The key thing is when you're looking at buying some investment assets, whether it be property or whether you're looking at setting up a business, it's really important to go and see your advisor prior to doing anything. So we worked out earlier the sorts of questions you need to ask your accountant. So if your accountant gives you, the answers that show that they're not really an expert in that area, you need to find somebody that is. So clients would come to me, I would sit down with them, I'd work out what their overall objectives are. I would then suggest that if they're looking for property, they need to make sure that they're what I call market ready. So they need to have their structures set up and ready to go. They need to have their finance approval done, and you need to realise that the finance approval is done in the name of the entity, not in your personal name.
So you may actually have to have the entity set up prior to even applying for the loan.
Definitely you have to have it set up because the bank want a copy of the trust deed. So you need to provide, when you go and see your finance broker, you'll need to provide them with the company and the trust. I normally have to provide a letter stating that the company is a non-trading entity and has no assets or liabilities, and that information then is part of the approval process when it comes to your mortgages.
Now, I also know that some people have said, well, what about off the plan? Well, they don't need a mortgage if it's off the plan, but in some, and I know this, in some jurisdictions, you cannot have a name on the contract of an entity that doesn't exist. You actually have to set up the entity beforehand in some jurisdictions.
That's correct. Otherwise, there's double stamp duty.
That's right. And that
they're trying to bring that in here as well in Victoria. Victoria at the moment is pretty much the only one that you can do the and or nominee. Depending on the the conveyancer or the solicitor you use to settle, some solicitors prefer that the contract is in the name of the entity. So to be in the name of the entity on signing the contract, that entity actually needs to exist.
Right.
Yeah.
Okay. Now, look, Martienne, we're actually out of time, but there's quite a number of questions that are coming through relating to having assets in your own name. So, Martienne, would it be okay if we did another webinar?
Sure. Well, why don't we get everybody to email you so that they can send their questions in on email, and then we can schedule another time and go through some of these questions and cover off some of the more high-level things that we haven't had time to cover off today.
Yeah, sure. Well, I mean, this webinar serves as a really great basis of understanding the structures and the terminology, but it's almost like Alice going down the rabbit hole. There is so much beyond this that people need to understand, particularly for having assets in their own name already. So look, that's what we'll do. Is we'll actually maybe in a month. Is that work?
Yep. What are we now? A month to
August.
6 weeks. Let's have a look. Yeah.
Okay.
A month
all right.
to 6 weeks. So if you can email in the questions that you have. So Stephen's email's up on the screen. So stephen@investorsprime.com.au, and give a little bit of a scenario, but please understand that the information that we give in a webinar is general and information only. It's not specific advice. So if you need specific advice, we wouldn't be able to cover that in a webinar, but we could certainly cover the general information.
Yeah, what we'll do is we'll collect the questions. We might amalgamate some of the questions. We'll take all the names out, and then that'll give you time to actually make some nice diagrams and things like that.
Sure.
And then we can go into a bit more detail and explain, particularly some of these, contractual wills and these second mortgages, and the benefits and the ups and downs, the positives and negatives of having caveats versus with unregistered second mortgages versus second mortgages, and the costs and those sorts of things, because it's a fascinating area that, in my opinion, not many people know about, and it's very, very cost effective to be able to protect your assets really well using the right debt structures. And no one really talks to you about that, because there's A, not a lot of people in my opinion know about it, but B, there's not a lot of benefit for you know, an accountant or a lawyer to go into a lot of trouble with this, and bankers certainly won't tell you. They probably don't even know. So yeah, let's we'll leave it there tonight, and if everyone just emails any further questions they have to me, or if they want more information about the fast track, or you know, any other thing that we can help you with, just let me know and we'll look after you. So I'd like to just say thank you very much, Martienne. It's been an absolute pleasure with you here tonight doing this webinar, and I look forward to our next webinar. And by the way, at our Fast Track event, Martienne speaks at the Fast Track event, and you'll have a chance to, in breaks, have a bit of a chance to chat with her and talk about your situation and learn some more from this amazing woman. So thanks very much, Martienne.
Thanks for having me. Talk to you all soon.